Welcome, everyone. My guest today is Mike Simonsen, founder of Altos Research, to talk about inventory and home prices in different markets across the country and what to expect from the housing market this fall. First, here's a word from our sponsor. Hi, I'm Sarah Wheeler, editor-in-chief at HW Media, talking to Desmond Smith, Chief Growth Officer at UWM, about SafeCheck. Desmond, how are trigger leads impacting borrowers?
Yes. Hi, Sarah. How are you? So trigger leads have become a very big issue throughout many industries, not just mortgages, but specifically to mortgages. What we've seen happen is a loan officer or a broker will pull credit, and sometime within minutes, but definitely within the hour, we've had consumers receive upwards of 40 calls. Within a day or two, they may receive hundreds of calls. So that's the reason that UWM created SafeCheck to protect borrowers.
Thanks, Desmond. And listeners, you can find out more about SafeCheck at uwm.com. Mike, welcome back to the podcast.
Great to be back.
Great to have you on. So we are at that point in the year and in the seasonal part of the housing market where everybody wants to know what is going on. And we've had such an unusual spring and summer as far as inventory and therefore prices. And now we're heading into fall. So I really think this is the perfect time to have you on to give us some of the data behind this. So of course, at Altos Research, you guys have some of the most real-time amazing data for down to specific markets. So we're so excited to get to delve into that.
Great. Let's talk.
Okay, let's talk. So first, catch us up on where the summer market has been, spring and summer. How has that been typical and how has it been atypical?
We started the year with, in a really freeze out from the fourth quarter of last year. And I was frankly expecting that we would have, therefore, we had such low demand in the fall that we expected that would continue in the spring, that therefore inventory would build. There would be more selection for buyers. And potentially then home prices correcting down at least a little bit. There wasn't any sign of big home price crash, but at least a little bit of home price correction down. We got none of that. We had surprising amounts of demand, like the buyers had settled into understanding that this is the financing environment that they're going to buy in. Rates had eased up from the 7s down back into the 6s. And so people bought homes. And as a result, when rates fell from November, middle of November, whenever the peak down to start ticking back down again to the start of the year, when people started buying houses. So the highest inventory of the year was January 1. Until right about now, it's starting to tick back up. Maybe next week we will have more homes on the market, 494,000 or something like that by next week, single family homes. And we started the year with 494,000. And so, in January and February, okay, you understand, but then in March and April and May, we were still way below and inventory didn't build at all. And it was fewer sellers, slightly more demand, like more buyers than sellers, and therefore inventory was falling all year. And that was really a surprise. Home prices adjusted down last fall. And so some of the year-over-year comparisons were lower. So like in June and July, home prices were May, June, July, where home prices were down year over year, but then they started to tick back up year over year because that's when the comparisons got easier to the fall. So we had, home prices are basically flat year over year, basically unchanged, maybe up a little bit, maybe down a little bit, depending on how you measure them. They're not falling, but the surprise of the year was that we had more buyers than sellers. And therefore the available inventory fell, and that really kept the floor on prices. Like there are more homes there are more buyers than there are homes to buy, and so therefore there's not downward pressure on home prices.
Let's talk a little bit because you mentioned those 494,000 number. Your numbers are different than the way Altos Research calculates things is different than say what people might be familiar with NAR. So give us a little bit of insight into how you come up with your numbers.
Yeah. So what Altos does is we track every home for sale in the country every week. All the pricing, all the supply and demand, and we literally count them. And when I talk about 494,000, I'm talking about single family homes. That we have another number that's the condos and townhomes. The markets tend to move together, but they're different, and so we like to focus on single family when I'm talking about national trends, and so that's it's a single family number. What NAR does is they go in a month. Now we're in August. They look back at July and they say, well, we can see these homes on the market and we can see these sold. So they must have been on the market, and they put them all together and they count like a big monthly inventory number. And so it includes homes that are in contract, which are no longer for sale. They're pendings. We have a different number for pendings, and there's 383,000 single family homes that are in contract right now, pending contract right now. And so, so when we're talking about active inventory, we're like, if you walk into the market today, there are 494,000 homes you can choose from. Well, that's it.
That is not a lot.
It's not a lot. No, just a few years ago, this time of year, it had been 1.2 million, something like that. Just like mid part of the last decade, 2015 timeframe. 2019, I think it was literally 100% higher than it is right now, 900,000, something like that, almost a million in August of 2019. So we're literally 50% of the homes, 50% fewer homes than you'd normally expect to be available. And we thought we might see it getting back to normal this year, but it did not.
Let's talk about that. The fact that January until, maybe this week, last week was the highest point of inventory for the whole year. And as you point out, I mean, this is in a rising rate environment. That's the most interesting thing, I think, to anyone watching the housing market is like, no one expected that demand, while it's not booming, it would be enough at this mortgage rate.
Yeah. Well, and here's what's interesting, Sarah, is it a rising rate environment? It was a rise. Rates rose last year, and inventory rose last year. And this is really a thing, like a rule. I'm calling it the Altos rule now. Higher rates equals higher inventory. Lower rates yields lower inventory. What happens is holding costs start to rise, and so we hold less. And when mortgage rates fall, holding costs fall for homes. So we hold more, we hoard them, and we don't sell them. And so for available inventory, what we've observed over the last bunch of years is when rates rise, inventory rises. When rates fall, inventory falls. And so rates rose dramatically last year, and inventory rose dramatically last year. But then most of the year this year, inventory and mortgage rates are actually ticking down from where they were. We're now in the space, actually in the last couple of months, where rates then went back from in the sixes. Now we're over sevens pretty reliably. We've been in this like upper six, lower sevens band for a couple of months now. We can see slowing in demand, buyer demand, like just a little bit. We can see a little bit of things that are softening, like affordability matters. But if in the second half of the year, if rates were to tick down into the sixes, you can expect inventory to crater down, like drop down with it. If rates, like last September, rates spiked and inventory spiked at the same time late in the year, which is very unusual. So we would see that same pattern this year.
So, Logan and I are always talking about mortgage rate lockdown. I'm on team mortgage rate lockdown. He is not. And you sound like you agree with Logan, but for maybe you're looking at it from a different perspective.
Yeah, I think of it. I think Logan and I get to the same conclusion, which is that the main point is that lower rates are not going to get us more inventory. They will get us more demand, and the demand will buy up more stuff and hold more stuff. So the inventory selection will actually fall. And so I think that's the concept is that if we say, well, people can't sell their homes because they're locked in, it's actually people don't sell their homes because they have a really good deal. And so, the rule of thumb that I am trying to get people to understand is the conceptual, or the common wisdom is that conventional wisdom is that once rates fall again, we'll start to see more inventory. But I think the data shows that the opposite is true, that once rates fall, it becomes easier to buy and easier to hold. And so I will spur demand, but not necessarily supply, or not as much supply.
Man, now I have you and Logan on the other side. That is a formidable team of people with a whole two different data sets coming at me. So, Logan and I are going to be talking about that on a live podcast at HousingWire Annual. And I think we need to just have you on the stage for that. I think you need to come up and be a part of that cage match, even though I'm stacking the other side. That's okay. I want us to get to the bottom of it. And I would like to mention to all of the listeners, Mike, you are one of our featured speakers at HousingWire Annual. That's October 10th through 12th. And you are going to be doing a deep dive, and then you can also talk to people. So it's a great opportunity for people to hear and get to meet you and talk to you, and also hear that really great talk that you're going to give on inventory and home prices and all the things that you see from your specific vantage point. So to
Yes,
that,
and I will also tell the story of the time that I saved Goldman Sachs from bankruptcy. So you got to show up to hear that story.
I cannot wait to hear that story. Yes, that will definitely be interesting. I think it's going to be great. We have an amazing lineup, and I'm so glad that you're part of it this year. Let's talk about home prices. So we talked about inventory, which obviously inventory demand kind of together. Tell us a story about home prices. From your perspective, what's been the most surprising thing about this year with home prices?
The most surprising thing about this year was that they didn't fall as much as I expected them to. And I didn't expect them to fall much, but they really didn't fall much at all. A couple of markets, but really in general, some markets didn't even correct down at all. So it was surprising that home prices held up better all year long than I expected them to. We could see that most of the year, we were recovering. Prices were recovering from big dips in July and September of last year when the mortgage rates spiked. Buyers backed way off, and so then all those sales prices were fewer offers and price reductions, and you could see that really clearly. And so our year over year comparisons will get easier in September. So this year, when we roll into September, October, November, assuming we don't have another mortgage rate spike, we'll end 2023 with home prices up 3%, 2%, somewhere in that range, up year over year. And that, what a surprise that was after the fourth quarter of last year, right?
Very surprising. So, one of the great things about Altos is that you guys can dig down into specific markets. This is not just some throw it to the wind. I mean, what's happening in markets. Catch us up on those pandemic markets, the ones we think of that really boomed when people were moving out to, they could do remote work. Think about Boise, you think about Austin. There's a lot of places. Where do those fall right now? What do prices look like there?
So Boise, Austin, Phoenix, Denver, the Western markets, the Western boom markets were the biggest up. They were also the fastest to adjust down late last year. So you could see it in the percentage of homes on the market taking price cuts, right? So that's a real indication. Buyers have stopped, demand has stopped, and oops, we missed the window. So now the sellers have to cut prices. You could see that. So normally about a third, or in some of those markets, maybe 40% of homes take a price cut before they sell. Those are normal times. And during the peak pandemic, it was only 12% needed to, because they were getting the multiple offers. And you can use that price reductions number as a real gauge for where demand is, organic levels of demand in the market. Then second half of last year, price reductions spiked, and they went from like 12% in Austin to 64% or something at the peak. Like 64%, 2/3 of the homes on the market had taken a price cut. That's not like, so like that's really cool. And so, but then those markets also recovered quickly. So it's like in the stock market, they call it high beta. Like the stock moves up or down more than the S&P, right? It's like more volatile. And you can look at those Western U.S. markets as high beta markets. They're more volatile than the market than the country as a whole. And so they recovered very well this year. You can start to see the price reductions starting to tick back up when rates have been stubbornly over 7%. It is an affordability window, and you can see it in that set. So we're now nationally, we're at 35% of the homes have taken a price cut, and that is in the normal range, but it's starting to inch up maybe a little bit above normal, like a little slower than normal. And in the last few weeks, rates have climbed, inching back up over 7. And you can imagine the buyers in the market making slightly fewer offers. Like, wow, I was hoping rates would go to 6.8, but they went to 7.2. I'm not making the offer. And slightly fewer offers means that slightly more of those sellers that don't get the offers, they say, well, I'm going to have to cut my price. And so we can see slight acceleration in the price reductions. It's both, seasonal. It's the second half of the year, and that's when you start cutting your price to move before the holidays or before school starts, move the place. But so it's slightly seasonal, but it looks like just a little more than seasonal. And that's a function of being where we are, with affordability.
We may have just gotten back from Gathering of Eagles, but we're not done with events for 2023 yet. This October, we're headed right back to Austin, Texas for HousingWire Annual, and we want to see you there. We've got a power-packed agenda with content such as our Women of Influence speakers, peak performer playbooks, CEO playbooks, and more to propel your company forward, as well as a bunch of networking events. Because this event is open to real estate executives, mortgage, title, and everyone in between, you really have the opportunity to network with people from all across the housing ecosystem. If you want to learn more about the event, or if you're already ready to get registered, head over to HousingWire.com on the events tab and you can learn all about it. Not to mention, if you're an HW Plus member, you're going to get 50% off your ticket. So get registered for HW Plus and get registered for the event so we can see you out in Austin.
So let's take a market like Austin or Boise or Denver and say pre-pandemic, what their prices were. Then, like where are we compared to like 2019 in some of those markets?
All of those markets, price-wise, are up from 2019, really strong, right? They had, 20, 30% per year appreciation. So if you're a homeowner in those markets, you're sitting on tons of equity. Most of those markets are still, inventory levels, level of supply climbed almost back to pre-pandemic normals, but then they dropped back down this year. And so, in Austin or Phoenix, especially, is back down. Other than the Western markets, the rest of the country, a lot of the rest of the country never got out of the pandemic crisis lows, the few of homes for sale. So supply really never climbed, especially in the Midwest and Central, out of the pandemic lows at all. So then in a place like Austin, though, inventory did climb. And Austin was like one of the very few markets where inventory got back to 2019 levels. But 2019 was already pretty low compared to the early part of the decade. So anyway, you're sitting on lots of equity, even though there was some price, adjustment down. If you bought in June of 2022 in Austin and you're in a bidding war, you probably have a negative equity right now. that's not that many people, but and so then, I hope you're planning to stay in your house for a handful of years, which most Americans are, and and ride it out. Like, if you have to sell, right, there's a handful of people who are upside down right now.
Interesting. Earlier this summer, I saw so Austin is a market I know pretty well just because I went to school near there. I have family that lives there. I'm down there all the time. I look at it, quite a bit. So there was this whole thread of this person on Twitter going by different builder sites and being like, it's abandoned, it's about to crash. There's nobody here. And I was like, yeah, do you know anybody in Austin? Because that's not what's happening. But to your point, it's not all boomtown, and all of those have seen some corrections, right? Where have there been of course, a lot of other places have been so much less volatile, right? I mean, I think of like the East Coast markets in some ways. Where have there been really stable markets, or even, I mean, are there any markets that have seen a market decrease in home prices over the last couple of years?
A market increase in home prices over the last
No,
couple of years?
a decrease. Are there
Decrease.
any ones
Oh,
that
has there
that
any? Well, yeah. So I live in San Francisco, and San Francisco is in a real wrenching change right now. The downtown office vacancy is like 30% officially, but the cell phone traffic data is down like 70%. Like, there's 70% fewer people that go to the office downtown San Francisco, and some of those people are working at their homes in San Francisco. Some of them are, like, well, if I can live anywhere in the world and still work, they are choosing to live anywhere in the world. And so there's a lot of change to still go through for San Francisco. And it's really, the type of work is like so concentrated tech, easy to go elsewhere. It was easy to go elsewhere. And so San Francisco has home prices are down, but you don't have to go very far outside of the city to where, people who you move a little bit further out get a little more affordability. And so the stability happens there really, pretty quickly. So there are a handful of markets like that. The real expensive, real tech focused places are, slower to recover.
So what about Seattle? That's always been on the, some of the most
So,
expensive
yeah, Seattle
clothing
is
in the
a
country.
similar pattern, right? Seattle's a similar pattern, similar, not as extreme affordability challenges, but similar, and similar workforce. It's like all of the live by the sword, die by the sword, stories. Seattle's been a massive growth market for 20 years, and right now is it's in the other side of that correction.
So the other market I wanted to ask you about was Tampa, Florida. Tampa was just like on fire, as far as I think you had a lot of in-migration, but just like their price acceleration was, notable over the last couple of years. What is Tampa doing?
So Tampa and other Central Florida markets were notable this year in that. So that, we talked about price reductions in the Western U.S. They spiked last year. As those Western U.S. markets improved faster, the Central Florida markets were dominating the price reductions earlier this year. So they were like lagging a little bit on the recovery that the Western U.S. had. So they had, everybody had a slowdown in the fourth quarter. Central Florida markets lagged a little bit in and as measured by like watching how many price reductions people are doing. Inventory is in those markets like Tampa or Orlando is up, off the pandemic lows, but still not really high. And so, price appreciation is roughly flat. It depends on where you look exactly, up a little bit, down a little bit year over year. And there aren't signals that I can see of home prices climbing like dramatically in the near future, right? So we can see there's like a balanced or slightly elevated number of price reductions right now. So that means that homes are on the market now. If they don't have their offers, they do a price cut, then they get an offer in September. And so, then that closes in October, and you start, hearing about that in November. So you can really see that, prices in Central Florida, for example, look pretty stable. There's no real upward pressure, even though, the inbound migration things are still underway. There's it looks like like we're going to see flat years in those kind of markets.
Interesting. The last area of the country I wanted to talk to you about was the Midwest. We hear these stories of lots of people moving to very affordable markets and actually maybe changing the calculus of those markets if you have enough people coming in. But what does the Midwest look like over the last couple of years?
The Midwest was really notable in that Midwest and actually Northeast, all the way up Midwest and Northeast, had this similar patterns. Was that the immigration boom in the sunshine, the smile states, that immigration is coming from the Midwest, right? And so when rates jumped, though that demand stopped in Arizona, moving from Chicago to Arizona, or from New York to Florida. And so that demand stopped, and that's why we could see price reductions kick, we could see inventory climb, we could see all of those things happen. That really dramatic move from say Chicago to Arizona was super easy at 2% mortgage rates, and so suddenly that stopped. So what happens then is that in the Midwest, they didn't have that buyer demand to gobble up inventory. So when the demand stopped, inventory didn't rise. Right? It was that dynamic was not there. So in other words, the notable thing in the beginning of this year was like, wow, Chicago and Pittsburgh and even Connecticut, they had not climbed off of the pandemic lows of inventory. Like they were still at these ultra lows of inventory. And that was a real signal early this year, is that, wow, prices can't really fall because there's a third of the normal number of homes on the market. And so you got normal numbers of people getting married and whatever, like buying homes and like doing life events. And so there are just too few homes available in all those markets. And so they didn't have the big investor presence. They don't have like the big, iBuyer presence. They don't have all of those things were not there. And so when that demand, those were the parts of demand that stopped very quickly. And so you didn't see any inventory build because there was nothing to build there. And that I thought was really notable. If you have a broad slowdown, like a 2008, oh my God, things are crashing, you'd see it everywhere, right? You'd see, wow, Americans are like stopped. We see that in, and you could see different local patterns, and you could see that was the further out in the exurbs that was worse. But we saw the slowdown really dramatically in the boom markets, but not in much of the rest of the country. And so that was what was notable early this year about the Midwest and Northeast. And it was surprising, but it was also really informative to me at the time. Like, wow, we're not going to get an inventory surge this year if, these markets, a big population of the country is still at, a third of the normal inventory.
That is so crazy. I mean, I just think that every year for the last couple of years, right? I've been like, we talked about 2020 was unprecedented. It certainly was. But in housing for the last, since 2020, it has been crazy every year for different reasons, and that is probably the most surprising thing, and then how that drives home prices. So let's talk about.
And, it's been, there's a lot of money, slushing around the system. And in some ways there still is. I was talking to on the Altos podcast, somebody who runs a big investment, single family investment oriented firm, and he was saying that that there are so many funds with dedicated cash that is assigned to purchase single family homes, that as soon as prices adjust down just a little bit, then the cap rates get just right in the window and they buy it because they have to buy it. And that's literally cash sitting on the sidelines. And we saw that, you could see that in like Phoenix this year. You could see that there was a really precise floor. The cap rate gets to whatever X percent and they'll buy everything.
Wow, that's crazy, and to think that that's still happening. And that's my next question. My last question for you is, what does the fall look like? What does the fall going into winter look like?
So, the thing that we're noticing now, and it's really subtle, a subtle slowdown in demand. And so, this week mortgage rates are at 7.2 or something like that. And like I said, that definitely impacts affordability. So that means that inventory would grow later into the year, a few more weeks probably, if rates continue to go up. So we don't predict mortgage rates at Altos. Like, we measure the housing market. So I don't know, do rates go up? Do they go? I don't have any idea. I've been unable to predict that for 30 years. I've been wrong for 30 years. So if rates go up, though, we can see the consumer sensitivity. We can see that inventory can climb even super late into the year. And if rates were to spike, for example, if we have, continued strong economy, we've had surprisingly strong economy, been expecting recession for a year and a half now, but we've had surprisingly strong economy. And so if those numbers continue to be strong, if inflation doesn't tick down as much as we'd like, or something like that, you can imagine that mortgage rates would spike, and that would, higher rates means higher inventory, means less demand, and therefore some of the year-over-year price gains could get squeezed back out, and we could end closer to flat in home prices. Right now, I would expect us to end the year with, like I said, about 3% home price appreciation nationally. And we will end the year with about 15 to 20% fewer homes on the market than we started the year, closer to 400,000 from 500,000. So we there's no signal anywhere in the data of a surge in inventory, whether it's like investors selling or distressed seller homeowners. Like, there's no signal anywhere in the data, Airbnb, whatever it is. There's a lot of fears that those may happen, but there's no signal anywhere in the data that it is yet happening. And so, so that's what we'd look for the rest of the year. If rates were to nudge down into the sixes and mid sixes, then I would expect that to accelerate purchases, a little bit of demand in the second half of the year, and inventory would then fall even further, lower rates, lower inventory, even further, and end the year, maybe, under 400,000 single family homes on the market.
Unbelievable. What a great, I mean, I believe you. I don't mean unbelievable that, but it's just such a crazy market. And to think that that's, that might even be then like a third of the normal homes that we would have on the market, right? If we usually have what, 1.2?
Yeah, I think, well, depending on where you compare to, but yeah, like, it is half of what it was in 2019. Like I said, there's no signal that it would surge. If rates went to 10%, inventory would climb, a lot. Maybe that would throw everything up. I don't know what 8% will look like, but rising rates, rising inventory, and if rates slide down, will spur demand and holding, and so we will have fewer homes. So, like, that's really the outlook for the rest of the year. And really, it's, as you say, unbelievable. And what's unbelievable is, if you think 6 months ago or 8 months ago now, beginning of the year, like, what I was expecting at the beginning of the year was not this. It's significantly stronger performance this year than I expected. At that point, we were looking at, expecting, well, recession kicks in and and buyer demand stays low. And therefore we, like this point of the year, I was expecting maybe we had 700,000 homes on the market right now. And, we're under 500,000. So, each week our little inventory forecast model was adjusted down every week, almost every week all year long, just like, and so anyway, there's still no signs. If recession finally does come, how does that impact? You can imagine that would drive some, distressed sellers, but that inventory is probably another year out. That's probably 2025 inventory. So, as of right now, there's no signal anywhere in the data for any surge in inventory.
Well, Mike, thank you so much for being on. Again, I would tell our listeners, come to HousingWire Annual so you can meet Mike in person, hear that amazing story. And Altos Research, it's an incredible resource, obviously, that we use all the time. And to be able to track inventory to the level that you can in real time for every market is amazing. So, Mike, thanks for being on. And I will have you on again in a couple of months, and we'll talk about what the fall market, and we'll just keep this conversation going.
See what's the latest. All right. Well, the data is always fresh, so we always have something to talk about.
I love it. Thanks, Mike.
All right. Thanks, Sarah.